Hi, I'm Daniel Schwartzman, Director of the Seeking Alpha Marketplace. We're doing another coronavirus-inspired roundtable. Today, I'm speaking to Mike Heroux, who is the author. He writes as the Dividend Guy on Seeking Alpha, author of Dividend Growth Rocks, a service focused on stocks doubling their payouts within 10 years. So, Mike, how are you doing?
Hey, thank you, Daniel. I'm doing fine, actually. I'm working from home, so not much difference.
It is the joys of being used to this sort of environment.
Yeah, definitely.
So I wanted to just start with your philosophy because I think a lot of our readers on Seeking Alpha, dividend investing and dividend growth investing is very popular, but I still think it's worth sort of setting the table as far as your investing philosophy centers on companies that are raising their dividends, as you know, doubling their payout within 10 years was what you have in your service. Why focus on that?
I think also it's a good thing to just mention. A lot of people are saying, "Well, Mike, you're writing under the moniker the Dividend Guy," but I focus a lot more on dividend growth than dividend yield. As you can see, most companies that will show a 6, 7, 8% dividend growth over a period of like 10 to 20 years will not likely have a huge yield. It's more towards a mix between a growth and a dividend approach. The reason why I've decided to focus on that is, when you have like, I use like three metrics to start my filters, and which I call the dividend triangle. So the dividend triangle is basically looking at companies showing revenue growth, earning growth, and dividend growth. So the combination of those three metrics will tell me that I'm looking at a company that is likely a leader in the market, has strong market shares, robust financials. So I'm kind of like getting rid of all the bad companies in one filter. And then I can do more digging into like making the difference of why this company is growing their earnings, or why the revenues are not growing, and so on, and go a little bit deeper. And I found that companies that are able to grow their payouts year after year for decades, well, they're good business at the same time. So you're picking among like only the best cherries out of the basket. Uh, I've looked at a lot of research also, even Vanguard, who's selling ETF, they're showing that dividend growers tend to outperform the market and do it with less volatility. So you're basically making more money and without less stress. So I kind of like that strategy for that reason.
Well, I just wanted to drill in the dividend part of that because I understand dividend growth is going to match earning growth or else you're in trouble.
Yeah.
So, but what does the extra element of screening for dividend growth instead of just screening for revenue and earnings growth? What is the fact that they're dividend payers? What does that mean for you?
Well, paying a dividend is a commitment. It's a commitment to success for today and for the years that is coming. Because management, they know when they pay a dividend, and especially when they increase it, especially like in those kind of crazy times. We saw like companies like Pepsi, for example, increase their dividend not too long ago. When they do that, they're making a strong statement of confidence in their business model and that things were going to do well in the future. So it's not only about revenue growth and earnings, it's also about the fact that the company says, oh, you know what? We have enough money to grow our business and also reward shareholders. Because sometimes you see a lot of people like they're focused on cash flow, on revenue growth, but at one point in time, I'd like to see companies that are able to make that commitment with shareholders at the same time that they're pursuing their growth in their business.
Okay, got it. So, and I'm glad you mentioned Pepsi as an example of a company that raised their dividend. This is obviously a period of a lot of stress. I mean, we're recording this May 8th. We're still only 2 or 3 months into this whole changing market. And even though equities have recovered to a large degree, there's still a lot of uncertainty. So, are you adjusting your approach at all for the fact that companies might not be able to grow even if they're high quality companies? Or how are you thinking about that in this period?
Yeah, I actually have to, because I had before that pandemic, I had very like two reasons for selling. The first one was a dividend cut. If a company cuts their dividend, it would be an immediate sell. And if a company forgets to increase its dividend, so it paused a dividend growth policy, it would be very close to a sell in my strategy. Now I have to put that in context. A very good example would be Disney. This is a week that announced that they would be suspending their dividend. And actually, Disney is one of my favorite stocks. I was not surprised. I was expecting a suspension because when you put it in context, parks and cruises are about 45% of their operating income, and now they're closed. So how do you expect a business to make money when they're closed? It just doesn't make sense, even though they have, now they're sitting on 14 billion in cash, so they could continue to pay the dividend, but it doesn't really make sense when you think about all this uncertainty around it. So I rather have a company which making a courageous decision to say, oh, we're going to keep the money inside the business. So if it drags longer, if we have more challenges down the road, and if business is not as usual in 2021, well, we'll have more cash on hand to react, and it's just creating flexibility. So what I've seen right now is a lot of dividend cuts and suspensions are coming from either two types of businesses: those who didn't do well beforehand, so their business model was already shaky in 2019 or 2018, so now the pandemic is just pushing them down the stairs. It's just accelerating the process of the business not doing well, I'm losing market shares, I'm not evolving quickly enough, so now I have a bigger problem, I have to cut my dividend. And then you have other types of businesses that are like Disney, just can't operate. So you just have to be more lenient on that part. And now I treat it more as a case by case basis. So depending on what the business looks like before the pandemic and which kind of environment they have to evolve into in the meantime, that will tell me a lot about what's going to come up next. Second reason of selling it, which is the most important one for me, is if the company doesn't meet my investment thesis at all. So basically what I do is I do my full research as any other investors before pulling the trigger button. And then once I buy a company, I look at it every quarter. So I look at the earnings and I make sure that the company is heading towards what I think it is. For Disney, well, this company is the emperor of content. They have this magical way to pick up any ideas, any characters, and multiply into like several income streams. They did it in the past also through acquisition. So they did Pixar, they bought Marvel and then Lucasfilm, and they just did it again with Fox assets. And they created a new stream of income with Disney Plus and ESPN. So when I look at the company right now, my investment thesis is still the same. It makes sense. They're still going towards the right direction. And actually, it's kind of funny because while parks are closed, well, Disney Plus is thriving. So it's not going to be a profit maker right away, but they expected to reach 60 million by 2024, I think, when they launched the service. And they're already at 55 subscribers and 34, 35 million paid subscribers right now already. So the business model is working well. And once the economy reopened, and we saw that in the news this morning, they could open their Shanghai park. Only it's at 30% of capacity. So it's nothing to say, oh yeah, well, they're going to make a lot of money from it. But the response from customers, they sold out. They sold all their tickets right away. So they show that there's still a valid business model. People will still go to parks and eventually to cruises and so on. People will need vacation at one point. So as long as the investment thesis is strong and valid, I'll keep my shares, even if they suspend or cut their dividend.
Yeah, so I also own Disney shares, and it's interesting to think about the acceleration. This has really accelerated Disney Plus, for example. Whether or not, there's all these other effects. It's slowing down production. Who knows when the next Mandalorian season or whatever else comes out? But it's
don't tell me they're delaying in. There's a delay there. Please.
I'm in Spain. We just finished season 1. They just rolled it out, so for me, it's really fresh. But so one thing we did a recent roundtable interview on the site with a few authors, including you, and you mentioned, and I've seen you mention this in your work before, that you're 100% invested, and I'm pretty sure you're a long-term investor. You seem like a long-term investor. So my question to you is, are you making any changes to your portfolio in this period? Are you trading? Are you adding or removing? Are you readjusting given all the uncertainty and all the fluctuations in the market we've had?
Yeah, what I did is I've looked into each of my holdings and added the COVID-19 context around it to see if the company can first survive and then thrive later on the road. appeared that most of my holdings were meeting those criteria, so I was fine with it. So I did a little bit of tweaking. Basically, what I suggest to my members as well is to rate their stocks in terms of dividend safety, saying like, well, can they still pay their dividend? Will it increase? Or if you expect a dividend cut, what's the outcome of it? Like, is it because a temporary thing like Disney, or you're looking at an energy stock, which is likely to go through several years of bad earnings and bad revenue, and they might even go bankrupt. So you have to make the difference here. I did a few small changes. Like I had a small position in Bank OZK, which I really like their business model. They have a growth vector, strong growth vector in the specialty real estate units. So basically, they're financing like condo towers and parking lots and stuff like that in large metro city like New York City, for example, or Miami. And the reason why I sold them, even though they increased their dividend not too long ago, was the situation in New York right now is quite concerning in terms of the COVID-19. And the bulk of their loans and their growth vector is in New York City. So I thought, well, you know what? I don't really feel like I want to take that risk and it could turn out well. But the thing is, it's a great business at the wrong place at the wrong time. That's the only thing. So I decided to sell those shares and buy OpenText. OpenText, they're doing ERPs, so they're basically helping companies to manage their data, and it's all cloud-based. They have over 100,000 clients. It's all working onto subscription models, so recurring revenue all the time. It's a small company based in Canada, but they trade also on the New York Stock Exchange. So for that reason, I thought, well, you know what? It's a good, like, just to increase my exposure to the tech sector would be a good thing right now, and getting rid of a regional bank, which are likely going to get hit if things turn sour. Nobody knows. I'm optimist, obviously, all the time. I'm always 100% invested in equities. But still, it doesn't mean that I have to close my eyes and just run into the dark and then scream, you know?
Well, and financials are in a tough spot. Even if you have recovery, interest rates are back down to zero in the U.S. There's a lot of stress on the system. It's hard to see the bull case that you would have had in February. It seems that's a case of a thesis changing, you would think.
Yeah, definitely. Actually, in terms of financials, maybe it's because I'm Canadian, but the only one I trust right now are Canadian banks, mostly for like two reasons. The first one, it's most likely the strongest banking system in the world. They are well capitalized, and they are like government rules that prevent them from taking too much risk. They just cannot do it. It's not because they want to, because I'm pretty sure they would, but at least now they're well capitalized and they are backed by the government. They don't have to, like, the government doesn't have to back like 60 regional banks. If they stick to the big five or the big six, they're going to be fine. And I don't think that it's going to be a problem. Most CEOs, they came out in March saying, you know what, we have no intention in touching our dividend. We have plenty of money still. We can take those losses from defaults and bankruptcies. And we don't want to touch the dividend because we know it will have another impact on retirees and the entire economy, because a lot of pension plans depend on those generous 4 or 5% dividend yield as well. So this is pretty much the only place where I would put money right now. I have Royal Bank and National Bank in my portfolio though.
Got it. Okay, interesting. Yeah, I do have one U.S. regional bank in my portfolio, but I actually did trim some of it in this period, just given the situation. So you talked about the COVID-19 context. We're, again, May 8th. We're sort of midway through earnings season. What are you learning so far? What are you watching for as you try to inform? Obviously, also the COVID-19 story is developing, but how are you adjusting your context given where we are in the market?
Well, I really like to read the comments from CEOs telling me what's happening inside the business. Sometimes I'm a bit disappointed because it looks like they all start with the same phrase, or it's important to stay healthy. We care about our employees, and it's fine. But I mean, it's not telling me how the business is doing, you know? So I would like to know, like, which kind of steps are you making? What are your liquidity looks like right now? What's going to happen next? We talked about Disney already, but another Another example would have been Hasbro. Hasbro had a tough year in 2019 on the market, very tough start in 2018 to 2020. I mean, again, but then the CEO said, you know what? Our manufacturers in China are restarting in February and March. We're full throttle on production on board games like Monopoly and Risk because people are getting bored and they want to play board games. And I thought, well, their acquisition with Entertainment One, with E1, it could be a good thing because they were moving a little bit more with digital and TV producing, which a lot of people have time to watch right now. So I was interested in knowing that manufacturers were restarting, that they were sitting on about like $500 million in cash. So they have strong liquidity right now. They didn't have to expect any shortcomings of cash going forward. So those are the kind of things that I'm looking for when I look at quarterly earnings. So some of them are very detailed, which I appreciate. Some others, they're still vague. And in those time, I'm just pushing those companies a little bit towards the sell button just for that reason. But so far, it has been good. So
That's it really interesting about Hasbro. Of course, if you want to spend quarantine time playing a game of Monopoly or Risk, which will take hours and hours, is one way to spend your time. But also the E1, so the E1 acquisition opens them up a little bit more to a digital. You said it was video editing or video production, yes?
yeah, well, that's what is interesting also about Hasbro is, there's a lot of businesses went through mergers and acquisition in 2019 because the economy was good, debt was still cheap. And then now you have to look at those companies and say, well, did they took a huge bite and they can't swallow it anymore, or they can still go through it? So I was happy to see, well, okay, they spent more than $3 billion on that deal. Now they're moving. They can do a lot of synergy between, like they have Power Rangers and now they have like rights on Transformers. So they like entering into the TV world and the entertainment world on this part I think was a good move. And I was happy to see, well, once the transaction is done, they still have cash on hand and they can still continue their integration.
Okay. So, any other names that you like right now? Any other names that you're looking to add or that you have added?
Yeah, I also like another small transaction I did was to trim a few shares of Apple, not because I don't like the company, but because this one was doing very well compared to the rest of my portfolio. And at one point in time, I had like 14% of my entire portfolio concentrated in Apple. And I really like the business, but at one point, it's time to let go a few shares still and diversify. So this is what I did. And I bought VF Corporation. They're managing apparel brands such as Vans and the North Face. And what I like about this business, first, it got killed early in 2020 and in 2020. So it was a great opportunity to catch up on this business with a yield that is more close to like 2.53% instead of having something around like 1.5%. Mm-hmm. But what I really like about this company is they're not in the apparel business. They're in the brand managing business. So they manage their portfolio of brands and they are very active in acquiring new brands or selling others, or they recently spun off their jeans brand Wrangler into Contour. I'm not sure I pronounced it right, but they did that spin-off last year. So basically what they do is they buy brands, they optimize it, and they then decide to either keep them because they're doing well, or they just sold them at a profit, and they keep repeating that for more than 100 years. So it is in their DNA. And I think that this one, I will have to be patient because obviously people are not running through stores tomorrow morning and it's going to take a while. But this is why it makes it such an interesting buy, because right now it looks a lot cheaper than it used to be a couple of months ago. So it was on my radar for a while. So I think that's the trick. Right now, the market has recovered greatly. Some people may be hesitant. So what I would suggest to them is just, prepare your buy list right away. Make sure that you have your list already. And then all those companies that you don't like right now in your portfolio and they lost money, don't look at it as, oh, I'm losing money, so I'm going to hold on to it because I lost 40% and it's going to come back one day. It may or it may not, but that's irrelevant. So if you lost $20,000 on an investment, that's completely irrelevant. Look at what's remaining. So, okay, so you went from 30,000 to 10,000. So you lost like 2/3 of your investment. What you have right now is $10,000. Where can you put that $10,000 today to make it grow? Because that 20 is gone. You forget about it. It's not coming back anytime soon. Now you see, oh, do I keep my position, or I look at my potential buy list, and do I see a company that is more exciting, more interesting right now that is on my buy list instead of what I have in my portfolio? And this is the kind of decision that you have to make, not thinking, oh, I'm losing too much on that trade, so I'm going to hold on to it and hopefully recover part of it when the market goes back up. Yes, it will happen, but you're going to make a lot more money if you're buying a company that is thriving, that shows strong dividend growth profile, instead of keeping your dead stocks in your portfolio.
There are so many, if you think of all those psychological biases that we've learned, so many of them are embedded in what you just said in terms of endowment bias and thinking that your stocks are better than somebody else's stocks, anchoring, loss aversion. There's just so much in there. And so what I think the pandemic is nice, or an event like this, is it really kind of knocks you over the head as far as, again, accelerating decisions you maybe should have made already. And so it's an opportunity in a sense.
Yeah, I really see the pandemic as an accelerator for pretty much everything. You know, this morning I was reading an article about retail stores in Quebec not doing so well because and it's kind of funny because the journalist was saying it's because of the pandemic, but there are some of those companies that were public companies that I used to follow a few years before, and I was already rating them as sell in 2019 or 2018 because the business model was not doing so well anyway. So yes, the pandemic is bad for them, but they would have most likely gone bankrupt or having financial problems anyway. Maybe it would have been 2-3 years down the road, but it would have happened anyway. So it's just an accelerator. At the same time, you see the complete opposite. You see companies thriving. I mean, this week we had Shopify, which I know it doesn't pay dividend. I don't have it in my portfolio, but just to show you, it is now the largest company on the Canadian market in terms of market capitalization. It's larger than Royal Bank. Mm-hmm. Why? Because the company's thriving. Their business model is made for pandemic. That's the complete opposite. But so while we're going to lose jobs, we're going to see bankruptcies, we're also going to see companies that will be thriving in the future. And we've seen the tech industry. I have a lot of Microsoft in my portfolio, and I wrote an article on Seeking Alpha not too long ago talking about, you know, valuation versus expected growth. And Microsoft seems to be overvalued all the time over the past 5 years. Pretty much at any years, you would find most people agreeing on the fact that Microsoft is overvalued. But the fact it's overvalued doesn't prevent the company from growing. It doesn't prevent the company from benefiting from this pandemic to grow even faster and better. And this is why I think that if I didn't have Microsoft in my portfolio already, I would buy it right away. Because in 10 years from now, it's still going to thrive as opposed to other companies.
Yeah, that's also the whole value versus quality argument that really comes to you really sort of see what that means when you have market sell-offs and when you have situations where companies may be decaying and then accelerating their decay, or thriving and accelerating their success.
Yeah.
So, okay, I've been speaking with Mike Heroux, who is the author, again, writes as the Dividend Guy on Seeking Alpha, author of Dividend Growth Rocks. Mike, any disclosures before we wrap up? I mean, it sounded like there were a few names that you have in your portfolio.
Yeah, just to wrap it up, I have shares of Microsoft, OpenText, VF Corporation, Apple, Disney. It's pretty much all the stocks that we discussed, right?
Hasbro,
yeah.
The Canadian banks, I think.
Royal Bank and National Bank, that's correct.
Okay, right. And I have a position in Disney. So not looking to add right now, looking to see how things...
Yeah.
So, okay, well, Mike, this has been a lot of fun. Thank you so much for taking your time today, and best of luck and best of health to you and your family.
Hey, thank you. Thanks for having me. It's always fun to talk about the stock market, and it will be. Actually, some people say sell and may go away. I think that this summer will be quite interesting, and I would not close my computer.
I think we're in for interesting. I don't think we've seen all of the heavy stuff
No,
yet.
no, definitely not.
So, okay. Take care.
Take care.